But from a tax strategy standpoint, the challenge is you got to get the stuff in for it to count for 2025, typically before the end of the year.
The other benefits to Roth conversions is that it can also lower your overall taxable income over your lifetime, because now you're accumulating this pot of money that you'll be able to draw on down the road tax-free.
One of the things that the bill did was made permanent some of the tax cuts that were implemented back with the Tax Cuts and Jobs Act.
So harvesting losses is a strategy where an investor will take an asset and they will sell it for less than they purchased, thereby recognizing the loss. So when you do this, there is some tax benefit in recognition of that loss.
I mean, imagine like almost $100,000 of income before you start paying any capital gains taxes. So pretty powerful.
Yes.
Hello, welcome back.
Hello, so good to see you.
Great to see you too. You're not in your normal
I'm
location.
not.
Where in the world is Atricia? Where in the world is she?
Today, Teresa's in Austin, Texas, where it is, I think the high today is 85 or 86 degrees.
Oh, amazing. Jelly.
Yeah, contrast that with the full-blown fall that we're in the DC metro area where it's been, 50s. So
Yep.
that's been a welcome change to have a little bit of warmth. But I'm not in my normal studio. Got like this background situation happening, but we'll make it
But
work.
she's
We gotta
making it happen, y'all.
show up for the Living Richly listeners. They're counting on us.
Exactly. These are the things that Atricia is willing to do for you all. So major gratitude. So
Yeah.
welcome back, everyone, to Living Richly with Curo. This is episode 79. My name is Ann McCabe. I am the CEO and a partner here at Curo Private Wealth, and I'm joined, as always, by my lovely partner in her second home of Austin, Texas.
Right. Hi, I am Atricia Roberts, COO and a partner here. Thanks so much for coming back if you've been here at the Living Richly Pod before or checking us out for the first time.
Yes, we love and appreciate you all. And if you are new to our podcast, our mission here is to educate, inspire, empower, sometimes entertain you on your financial journeys. And y'all, it's November, okay? So I know we've got, side note, I was in a store yesterday. They're already playing Christmas music. I'm like, what is this? But we have a few short weeks before the end of the year and before we welcome 2026. So today we want to talk about 3 tax strategies, proactive strategies that you may want to consider. We're not saying this is for everyone, but you may want to consider implementing before the end of the year. So that is what we're going to talk about today.
Yeah. And I mean, who can imagine at the end of the year is what, 8 weeks away, 7 weeks away?
Yeah. By the time this launches, probably 6.
Yeah, 6. Coming at us quick, guys.
Yeah, it really is. So let's make it count. There's still some time to do some things.
Yeah, so much we can do.
Yeah, so much you can do. But from a tax strategy standpoint, the challenge is you got to get the stuff in for it to count for 2025, typically before the end of the year. So we're giving you some time to think about these things and see if you want to implement them. So before we go into some of the strategies, we're just going to do a brief review of the One Big Beautiful Bill Act. We call that OBA because nobody has time to say the whole name every time. We have done 2 episodes deep diving into OBA. So we are not going to deep dive today. We are going to keep it super high level. But as a review, because we're talking about taxes, we wanted to go over some of the changes that either were already implemented as a result of OBA or will be implemented next year. So the bill was signed into law as of July 4th. So it is official. And one of the things that the bill did was made permanent some of the tax cuts that were implemented back with the Tax Cuts and Jobs Act, TCJA. So those tax cuts were scheduled to expire the end of this year. And thankfully, those are not going to expire because OBA was passed. So that was one of the big changes. Another change is that tax brackets were scheduled to revert back to what they were prior to the TCJA of 2017, but those were made permanent. So most taxpayers should, they may not necessarily feel like they're saving money on taxes, but most people will be saving money on taxes compared to what they would have gone to in 2026. The other thing is the higher standard deduction that was passed with the TCJA was made permanent. And there was also a slight increase to the standard deduction as well. And then a new deduction for seniors. So if you are age 65 or older, you potentially can get an additional $6,000 deduction. And that is brand new with the OBA. Now, there is a relatively low income phase out for that. So for single filers, it starts to phase out at 75,000, and for married filing jointly, it phases out at 150,000. So just keep that in mind. The other big thing that got a lot of attention was the SALT deduction, so state and local income tax deduction, or state and local tax deduction. That went from $10,000 all the way up to $40,000. So pretty substantial increase. And this does have a higher income phase out. So if your income is over 600,000, then you are fully limited to the $10,000. So at, think it's married filing jointly, the phase out starts at 500, and by 600, you're back down to that 10. And many more things. It was like 800
Right.
pages.
Oh, yeah, huge document. But those, I think, are the highlights. I think they're also the ones that we are starting to see impact our clients the most significantly as we work on our own internal tax preparation. Okay, so now let's get into some actual proactive tax planning. First, we want to distinguish between tax planning and tax preparation. Those are two different things. So, planning is getting ahead with some different tax strategies. Preparation is what you're usually doing the following year when you're filing your taxes from what happened in the year prior. We want to do the former. So, we want to be proactive today. So, we want to talk about some things that you can do for tax planning for 2025. The first, which we do a lot of here at the Curo team, is the harvesting. We're both having issues today. The harvesting of capital losses and gains. We'll get to it. So, capital gains rates are more favorable than ordinary income tax rates. They have a cap that's much lower than the highest marginal income tax bracket. So, looking at gain and loss harvesting can make a lot of sense for most investors. So, harvesting losses is a strategy where an investor will take an asset and they will sell it for less than they purchased, thereby recognizing the loss. So, when you do this, there is some tax benefit in recognition of that loss. You can use $3,000 of capital losses to offset ordinary income and can also offset any capital gains with those recognized capital losses. So, for example, let's say you bought a stock, Apple, and it's run up significantly and you want to rebalance and you're worried about locking in that taxable capital gain. But on the other hand, you have another stock. I don't know, we won't poop on anybody today. We'll call it XYZ stock that has been more of a dog. And that one has been trending downward. And now you own that position with a loss. You can sell both of those positions, the Apple that is run up significantly and the XYZ that has been mostly a dog, and take the losses from the sale of XYZ to offset the gain of the successful position. In my example, Apple. Now, on the other side of this, and this is the one I think investors are a little bit more nervous about, but there's also benefit in strategy to harvesting the gain of a position, or as like we like to say more casually, taking the gains off the table, right? We want to take the gains off the table. So if you are a married filing jointly tax filer, you can have up to $96,700 of income and pay 0% taxes on capital gains. So if you're in a lower income year, let's say, for example, you retired and maybe only worked the first quarter of the year, or you're self-employed and your income was significantly less in 2025. Now may be a good time to start harvesting those gains, take the gains off the table, and take advantage of a much lower or even 0% capital gains rate. So there's also some benefit in harvesting the gain in addition to harvesting the loss.
Yeah. And I totally agree that the harvesting of losses gets talked about a lot more
Yeah.
than the gains. And I think a lot of people don't realize that you can have a pretty, I mean, imagine like
Mhm.
almost $100,000 of income before you start paying any capital gains taxes. So pretty
Yes.
powerful.
Yeah.
All right. Number two, it is a great time and an important time to review your retirement plan contributions for the year. So if your goal is to fully fund a 401k, TSP, 403b, etc., are you on track to do that? This is the time that you want to look at it because you still do have a bit of time to tweak your contributions if you need to play catch up. So for 2025, the maximum employee contribution is 23,500, and there is a catch up of an additional 7,500 if you are over the age of 50. And remember, you just have to turn 50 this year. So even if you don't turn 50 until December 31st of this year, you still qualify for that catch up. And if you're between 60 and 63 this year, you get an additional $11,250 of contribution. So quite a bit. So figure out where you are in that age bracket, what your max is, and if your goal is to max, make sure that you are on track. One of the other things we wanted to remind you of that gets confusing sometimes is with these max contribution numbers, you do not have to consider your employer contribution. So if your company is matching your contribution, you don't have to like back that amount out of the maximum numbers that we just shared. That is over and above the amount that you can fund, which is great. So make sure that you're fully funding that employee portion if that is your goal, and you can swing it from a cash flow standpoint.
Yeah, super powerful to take advantage of those limits if you can do it. And of course, if you're making them pre-tax, there's also tax benefits because you're not paying taxes on that portion of your income. Alrighty. So our third tip, and it's one that we love. While I'm here in Austin, Texas, Ann and the Curo team are back home furiously working on this very thing, but it's exploring Roth IRA conversions. So in a Roth conversion, you take what was those pre-tax dollars, let's say, for example, things when you were maxing out 401ks, and you convert them to Roth assets. So now with the conversion, you are going to pay taxes on the amount you convert in that tax year, but then the money is never taxed again. The other benefits to Roth conversions is that it can also lower your overall taxable income over your lifetime because now you're accumulating this pot of money that you'll be able to draw on down the road tax free. You also don't have to take a required minimum distribution, which if you are already over the age of 70 and a half and or 73, you might be experiencing the IRS forcing you to take money out of retirement accounts and recognize taxes. Roth IRAs do not require a required minimum distribution at age 73 or now the new age of 75. And if you pass Roth assets to your beneficiaries, they don't pay taxes on the distributions either. So now there are a lot of factors to consider, like the conversion will disqualify for other deductions based on an increase in income that you're recognizing in that year. And it could also make things like Medicare premiums higher, which are based on modified adjusted gross income. So this is a strategy that you really want to partner with a professional to make sure that you're understanding all of the risk, all of the implications, and you have someone who can work out the numbers so that it makes the most sense for you.
Yes, that is exactly what we are knee deep in right
The
now on the Curo team.
professionals are Kira are running the
Holy
numbers.
cow, we are. We are crunching those numbers and making sure that we understand all of the impacts. So it is super, super gonna double click on that point and
Yeah.
reiterate how important it is to make sure
Yes.
that a professional is helping you because there are a lot of factors. All right, we lied, y'all. We said 3. We're going to give you 4 because that's what we like doing
Oh,
here is just giving you extra value that you didn't
extra
know was coming
bonuses,
at you.
bonuses.
Bonuses. If you're still listening and watching at this point, this is the gift that we're giving to you. So here's our bonus number 4. This is really reserved for some of our folks in the higher/highest tax brackets, but beginning in 2026. So this is really important. This is a new rule next year. There is going to be a floor implemented for charitable deductions. And basically, you can only deduct the amount of the charitable deduction if you are an itemizer that is above 0.5% of your adjusted gross income. So, for example, if you make $500,000 in the year, you can only deduct charitable contributions or donations that go above the $2,500. So we just took 0.5%, multiplied it by 500,000, and it gets you that 2,500. Okay, so that's something to be aware of for our itemizers. If you take a standard deduction, you don't need to worry about that. The other big change, and this absolutely does impact our folks in the highest tax bracket, is starting next year, the maximum amount of a deduction that folks in the highest tax bracket qualify for. Highest tax bracket is 37%. The maximum deduction amount is 35. So you're basically giving up a 2% deduction benefit there. So, if you are planning, for example, to make some charitable donations in 2026, one of the things you may want to consider is just accelerating those into 2025 because these changes that we just talked about don't go into effect until 2026. And if you accelerate those donations, it is possible that you can take advantage of a bit more favorable tax treatment in 2025 than in 2026. So that was something we wanted to mention for our folks in the highest tax bracket for you to be aware of.
Yeah.
So
And
there,
that's good tax
yeah,
planning.
exactly. Yeah, exactly. So there are so many more strategies, so many more nuances that could possibly impact you or that you may want to take advantage of. And again, this is why we reiterate the importance of working with a trusted professional who is aware of all of these changes and these opportunities to hopefully bring them to you if it makes sense for you to take advantage of them and really just help you understand all the moving parts and what it all means for you. So if you are not currently working with a trusted advisor, professional, we would love the opportunity to explore if we would be a good fit. So please feel free to reach out to us. Our website is curoprivatewealth.com. You can check us out there and book a call with us if that is of interest.
Yeah, we'd be happy to work with you.
We would. We love helping people, being of service. All right, Atricia, it is time for our closing thought of the day. So, what do you have for us?
Yeah, I actually have a good one today.
You have a good one every week, but okay.
But it's not my own. So I'm here in Austin finishing up a successor academy is what they call it, program for advisors who are taking over as leaders of practices. And so I've been doing this program for 2 years. But the founder and CEO of this program, Philip Pallavi, shout out to Philip, is full of all of these like just great analogies. He has a way of saying things that just make it click. So after one of the presentations yesterday, he was telling us to be mindful of the difference of being in motion and actually moving, right? Like you can stand up next to your chair and run in place and be in motion. You're not actually going anywhere though. And so many times people get distracted and caught up in thinking that they're doing things because they're in motion, but nothing's actually moving. And I thought that was such like a powerful picture. Like, yeah, you can get really busy sometimes and you're really in motion. There's a lot of things happening, but you're not actually moving anything forward, right? You're just busying yourself with little tasks, meaningful things that have very minimal impact to your goals and what you're trying to do. So it was a really start reminder for me, like, be mindful that you're not just in motion, but that
I
you're
love
actually
that.
doing the things that are moving you forward, moving your team forward, right? Moving your own personal development forward, and not just being busy and in motion.
Yeah. Oh my God. Let that all sink in. Let's just give that
I
one a
thought it was
moment.
so great. I was like, "Oh, that was a good one, Philip."
So good. So good. You're like, I'm stealing that for my closing thought for
Yeah.
our
Oh, for
podcast.
sure. That's it.
Amazing. But you gave him credit, so it's all good.
Oh, yeah.
Yeah, it's like we all have those days where we're crazy busy, right? Like you
Mhm.
literally feel like you're running around all day long. And then you get to the end of the day and you're like, what did I actually get done?
What
Like
did I get
I was
accomplished?
busy. Yeah, I was busy, but was I productive? Was I really focusing on the right things? Was I just like responding to emails all day long, you know? So I love that because in motion is not the same thing as
Yeah,
moving forward.
as moving forward.
Yeah. Ooh, love that. Thank you so much for sharing.
Yeah. Thanks,
Nugget of
Philip.
gold. Thanks, Philip. Yep. Thanks, Philip. Atrice and I are actually, I'm going to meet her in Austin on Monday, and we're going to do a whole strategic planning session with Philip
Yeah.
and one of our Blue String partners, John. So shout out to John too. So I'm
Yeah,
super
hi,
excited
John.
about that. Hi, John. All right. My closing thought for today is a bit more investment
Mm,
related. I was reading an article this week and it was on, one of the finance sites. I can't remember which, and I probably wouldn't share anyway. But the article was basically like, ooh, all these Wall Street CEOs are calling for a decline of 10% over the next year. And it was like, dun, dun, dun. And I'm like, are you serious right now?
10?
10 over a year. Like, okay, thank you, Captain Obvious. Like, we don't have crystal balls and we know that it's likely that something like that will happen. So, as I'm reading this article, you and I and our team know better because we've been in this industry for a long time and we've been through lots of market cycles. But I just wanted to remind, and if you're a client of ours, you hear us talk about this all the time. One of our favorite charts that JP Morgan puts out really reiterates this fact. But if you're not a client of ours, or if we haven't spoken in a while or reminded you about this, the average normal to be expected decline in the S&P 500 at any given point in any given year, going back to 1980, the average is about 14%. It's just normal. So when you read articles like this, or when you turn on the news and people are freaking out about, I think we're at like a 3% decline at this point off the highs. I mean, the S&P has hit over 30 all-time highs this year alone in 2025. So when you read an article like this, or when you watch the news, I just want you to remember the 14% number. Okay. So if people are freaking out about 3 or 5 or even 10, if you are a long-term stock/equity investor, you have to be prepared for pullbacks, and 10% is nothing in the scheme of things. If
No.
you need that money tomorrow, that would be a pretty dramatic loss for you. And at that point, you shouldn't have your money in the stock market, right? That money should not be in the
Right.
stock market. That money should be in cash. We talk about that all the time. But if
Ad
your
nauseam.
goal, ad nauseum, but if your goals and the money that this is being allocated or earmarked for is years in the future, decades in the future, like don't worry about the temporary declines. So that's my closing thought. It's very specific around investing and the markets. But when I saw this article, I was like, people are reading this thinking, like freaking out, because even the tone of the article was very much like bombastic and
Yeah, that's the
to
point.
right, to make people be afraid. Like, so what are you going to do with that? Are you going to sell and go to cash because you're worried that the market's going to sell off in 10% over a year? Like, how much more can it go up before it pulls back 10%,
Right.
right? So anyway, I'll get off my soapbox, but that is my closing
No,
thought.
that was I think that is a great reminder. It goes also to that behavioral piece and trying to stay centered, that centeredness we talk about, and not being swayed by headlines that are intentionally meant to rile you up. That's exactly what that is, because 10% is, to me, is like casual pullback. That stock's going on sale. That's not
Yeah.
panic. That's
No.
not panic mode.
Yeah, exactly. Totally not panic mode. When we're in the
Yeah.
20 plus 30%,
Right.
okay,
When we're in
now like we
correction
gotta,
territory, like, let's
yeah,
have another conversation.
right. Exactly. So
10%. Wow.
yeah, I could not believe it. I was like, ugh.
Yeah.
Y'all
Leave
should be
people alone.
ashamed of yourselves.
Yes, people have enough to be afraid about right now. Like, stop doing that.
Exactly. Exactly. All right, y'all. Well, thank you for tuning in for another episode. Thank you, Atricia, for
Of
making this
course.
happen in your hotel room in Austin. We appreciate the dedication and the commitment
I'm
that you
happy to be
show.
here.
Yeah. So we'll let you get back to your sessions, and we will catch the rest of you all next week for another invigorating episode, I promise. And until then,
Live richly.
thanks again for tuning in. If you enjoyed today's episode, please be sure to subscribe and share it with someone who might benefit from it. Friendly reminder that this is for informational purposes only. For additional information, please visit us at www.curoprivatewealth.com. Until next time, live richly.